Good afternoon, and you're watching Moneycontrol live stream. Welcome to the closing bell. I'm Santosh Nair.
And I'm Yatin Mota.
Well, benchmark indices continue to extend their losing streak. They fell for the fifth straight session today. The benchmark Sensex and Nifty ended lower by close to about 1%. But interestingly, small and mid-cap stocks, which had taken a big beating on Monday, they were also under pressure today, but not to the same extent as some of the large cap names, and that's taken some players by surprise, because they were expecting the selling pressure in small and mid caps to continue and money move out of small and mid caps to the large caps, but that trend doesn't seem to be playing out clearly at this point. PSU banks and metal stocks to some extent were the survivors in today's market. The respective indices for both these segments closed slightly higher, whereas selling pressure was seen across the board. Auto, IT were among the prominent losers of the day, as including defensive names like FMCG and pharma too came under selling pressure today. So Yatin, very clearly the big negatives today is that one is that the market benchmark indices have closed below their 100-day moving average, and the general chatter in the market is that this time more than institutions, probably it could be the HNIs who are booking profits, and because of which you're seeing such a big fall.
Absolutely, and I think that has been the trend for the past two trading sessions. Yesterday was a holiday, but on Monday we saw a lot of HNIs really selling off a few of these mid caps, and the panic really Santo lies in the mid cap and small cap indices, which were down almost a percent or so. If you look at stock specific actions, there were stocks which went down as much as 10-15% on the Nifty 500. If you look at the advance decline ratio also, it was 1:3, indicating that for every one advance there were three stocks which were declining.
The only saving grace probably, Yatin, is that it didn't seem as bad as it was on Monday.
Yes, absolutely, not as bad as Monday, because the SGX Nifty indicated a positive start in the morning, despite the fact that there was China stimulus. Hong Kong cut its real estate registration rates. Globally we have seen calm. Israel is also talking to Hamas when it comes to releasing of hostages, and no real plan is being there on the ground as feared by the markets. So on the global front, the news is not as worse as it was last week, but still if you look at the market closing, it was quite weak. Stock like Jubilant Pharma, Safari, Data Patterns, Sera fell almost 5 to 10%. However, Wellspun India, today's mid cap top gainer, flew by nearly 12% in trade after reporting strong second quarter earnings, and so did Aster DM and Amber, both stocks gaining 7-8%. We will talk about Amber Enterprises, but Santo, clearly the mid caps as well as the small caps taking a beating in today's session.
Well, the other interesting thing, Yatin, is that market has been talking about this rising bond yields in the US being one of the factors which has been pressurizing Indian shares. But at the same time, you have some of these bond market heavyweights like Bill Ackman and also Bill Gross, who have now changed their views. Bill Ackman in fact said that he was covering his short positions in US Treasury, and Bill Gross too said that he is going long selectively on bonds of certain tenure. So you think, Yatin, this could be in some ways a turning point for the bond market in the US?
So, Santo, difficult to tell, but a lot of these experts are saying that the bond yields in the US are almost 5% now, and there is no further scope for even Fed to hike rates, because once the bond market indicates a higher yield, probably the Fed feels that there is no requirement for a rate hike. So in a way it seems that we are at the end of the rate hiking cycle, but you never know what really happens on the geopolitical front, and hence the market is playing a risk of. In fact, if you look at the gold markets also, they have been almost trading at record highs. So there is fear in the market, but not really reflecting in the large caps. As I said earlier, it's mostly into mid caps and small caps. And Santo, on Monday also we indicated this on the VIX index, that there is no real institutional activity which is reflecting in the VIX index. And on that day, if you notice, the provisional figures for both FII and DI was positive. So despite the fact that institutions are buying, the VIX index is not really marching above that 14-15 mark. Things are calm, but yes, we need to wait and watch. And the froth really in the mid cap and small cap is leading the way down.
Well, and with that, let's take a quick look at and before we come on to the stocks, Yatin, there is a saying in stock market which says that the bear market doesn't start till the last bull has lost hope, and the other way around. So in the bond market also, Bill Ackman has been a bear for a very long time. So and the fact that he is now covering his short position probably could, as they say, be a sign that the worst may not be over yet. And well, with that, let's take a quick look at some of the stocks on our radar this afternoon, starting with SBI Cards and Payments. The stock had fallen sharply on Monday. It was down by about 1.4%. Today in trade, it managed to close flat in a weak market. Now, the September numbers have not been all that great for the industry in general, but it's been particularly negative for SBI Cards, though the number of issuances have gone up. SBI Cards, spending on SBI Card, they rose by about 7% year on year for September, but at the same time they were down by about 9% month on month, whereas for the industry the growth in spending was about 16% in September, but compared to 32% the previous month in August. So clearly things not looking very great for the credit card industry, but one of the reasons the players say is also because of the festive season starting a little late. So according to Morgan Stanley, which is bullish on SBI Cards and Payments, the spending numbers for October have been pretty strong. On aggregate basis, they are up close to about 33% so far in October. I had a chat with Digant Haria of GreenEdge Wealth, and he had a very interesting insight to give on SBI Cards and Payments. And according to him, the issue is slightly a little more deep rooted, because what his argument is that globally the big credit card player, they make most of their money out of consumer spending, not so much out of EMIs, whereas in India the trend is slightly different. And in the case of SBI, what Digant has been saying is that if you try to make more money out of lending, which is through EMIs, it will work well when it's an up cycle, but when the cycle changes for the worse, then you tend to get badly hit, as it has happened in the past also. So that is something that the market is not very comfortable with. And also the fact that while SBI has a very strong base, the share of high paying consumers among the premium consumers, the share of that is lower, let's say, compared to some of the other major card players. So those are the big concerns, as a result of which you've been seeing the stock moving in a narrow range. For much of last year, it hasn't done much. Briefly, it tried to get past the 950 mark, but has not really succeeded. So between 650 to about 800 has been the trading range for SBI Cards this year.
Absolutely, and that is one stock we'll watch out for. But the today's stock in focus was Amber Enterprises. Smart moves coming in for the stock, gained by nearly 7-8% intraday, and for the simple reason that the management guidance for the medium term growth and margin outlook was quite robust. In fact, a whole host of brokerages have increased the target price, including Jefferies, which has raised it to nearly 4,000 rupees per share. Now, Amber, as you know, manufactures air conditioners, and they do a lot of AC market work as well in terms of manufacturing electronics, and that has really worked under the Make in India theme. Now, if you look at Jefferies, they expect that the capex will normalize in FY25, because of which the return on capital employed should start looking higher in the coming financial years. Also, they see that the sales for Amber Enterprises should grow by nearly 2 times in the next 2 years. So the sales growth will be exponential for these companies. The market probably always worries about the margin picture, which obviously in the short term has been slightly wobbly. But yes, the management gave assurance to investors on the conference call that the margins picture should improve in the coming quarters, because of which the stock had seen a very sharp rally in trade today despite weak market conditions.
Well, the last stock on my watch list is JSW Steel. Now, Macquarie has rated the stock as neutral with a target price of 841 rupees. Now, the stock, the company came out with a decent set of second quarter numbers. Margins have been steady, and the kind of decline that you were seeing till the previous quarter, the pace of that appears to have come off a little bit. However, Macquarie is still not very bullish on the stock, and one of the reasons could be that it does not share the management's perception that steel prices may have bottomed out for the time being, and most analysts tracking the sector feel that even though domestic demand continues to remain fairly robust at this point, the big kicker for steel companies will really come when the global demand begins to improve, and at this point in time there is the outlook on economic growth both in US and Europe is slightly bearish, and the major joker in the pack appears to be China. The demand in China is quite weak at this point in time, but at the same time there are also reports that a lot of Chinese companies are dumping steel into Indian markets, and because of which the local steel players, the consumers, local steel consumers are able to get a better deal on imported steel rather than buy it from the domestic players. So those are the big concerns at this point in time.
I think there was a statement from some government official coming on the wires, Santo, that the government is looking to provide some bit of support to the Indian steel industry versus cheaper Chinese imports and overall imports as such, and in a few Chinese products, because steel companies manufacture a whole host of projects and products. We have a few segments wherein there is always a anti-dumping duty which has been initiated against Chinese steel imports. So let's see whether or not things really look up for the steel company, because the way the global economic headwinds are there, probably metal stocks are facing some bit of pressures in terms of overall realizations, and the peak margins are now looking lower on a year-on-year basis. That was about steel, but the other stock in the focus radar is HUL. Now, after the quarterly earnings, the stock saw the stock fall by nearly 3-4% in trade on a cumulative basis. Now, today HSBC has downgraded the stock of HUL. They've cut the target price by 10% to a level of 2,700. Now, in the last 5 years in terms of growth, HUL has been a laggard in the FMCG industry according to HSBC, and the second quarter lackluster performance really means that the stock could remain in a tight range or probably head lower from the current levels. In fact, HSBC sees a very little upside in the stock of HUL unless there is buying into defensive. So in a typical bear market or a weak market, we see institutions really buy the FMCG stocks to protect the portfolio. If that is the case, probably the HUL trade will work on the positive side, but for HSBC it means that HUL in terms of earnings should not be able to do something great in the next coming quarters.
Well, with HUL, that is the argument. The stock may have been a laggard for the last 5 years, but if you look at a 10-year period, investors who had stayed invested have made almost, it's been a 5-bagger for them. So then the question really comes to, what time frame do you look? Because typically investors in FMCG companies, given that anyway valuations are quite expensive, it is very hard to call the short-term trends in these stocks. And we saw something similar in the case of ITC also, where the stock, despite having doubled in the last 18 months, if you look at the 10-year returns, they're quite anemic. So interesting trend there in FMCG stock.
Yeah, I think FMCG is more like a buy and hold story, Santo, and as you rightly mentioned that these stocks might not give you returns for 2, 3, 5, 7 years, and probably 1 year certainly you will see the stock doubling, tripling in a short period of span, short period of span. And if you look at the stock of HUL or ITC, they have given abrupt returns, in somewhere the 90s, and then somewhere in late 2000s, and then middle of 2010-15. So FMCG stocks, as Santo is mentioning, give returns that could probably mean a lot to long-term investors, and the short-term trend probably should not be judged for longer-term investors.
Well, and with that, it's a wrap on this edition of Closing Bell. Thank you for watching.
Thanks for watching, and stay tuned to Moneycontrol for all your news, views and updates.